Market Outlook. Calendar Week 06. Review. Digital asset markets moved within an environment of elevated macroeconomic uncertainty and persistent geopolitical tensions. The interest rate structure remained restrictive, particularly due to still elevated real yields in the United States. At the same time, economic and labor market data showed no clear signs of easing, supporting expectations of a prolonged restrictive monetary policy environment. These conditions dampened risk appetite and resulted in an overall defensive market structure. Within the crypto market, this environment was reflected in declining market breadth and a clear concentration toward Bitcoin. Capital flows remained selective, while speculative segments stayed under pressure. Volatility appeared intermittently, but was largely event-driven and less indicative of a structural trend reversal. Against this backdrop, quantum data analytics consistently operated in research mode over the past week. Internal models simultaneously analyzed macro indicators, liquidity flows, derivatives data, and market structure. No stable statistical overlap emerged between spot demand, funding rates, and open interest. Correlations between macroeconomic impulses and short-term market reactions also remained inconsistent. For this reason, no research signals were deliberately developed. The absence of signals in this case reflects methodological discipline rather than insufficient market observation. As we transition into the new week, attention first turns to the structural leading indicators. Bitcoin dominance remains elevated within a narrow weekly range. This indicates continued capital concentration in the leading asset and signals restrained risk appetite across the broader market. In parallel, the Crypto Fear and Greed Index remains in a zone of pronounced fear. The combination of high dominance and low sentiment describes a market regime primarily focused on capital preservation and selective allocation. Next, attention shifts to the events of the coming week. Several macroeconomic releases, particularly from the United States and Europe, have the potential to influence short-term interest rate expectations, as well as the US dollar and real yields. Labor market data, purchasing manager indices, and industrial indicators affect risk assets directly through interest rate and currency transmission channels. For digital assets, this means that trading impulses arise less from crypto internal narratives and primarily from macroeconomic transmission mechanisms. In addition, token unlocks must be considered as a localized supply factor, especially during periods of reduced liquidity. Geopolitical developments act as an exogenous stress factor, capable of amplifying volatility and triggering short-term position adjustments. Based on this overall picture, the potential positioning of quantum data analytics remains cautious. As long as no clear and consistent structure emerges between the macro environment, liquidity dynamics, and derivatives markets, the focus remains on observation, model validation, and risk control. Research signals are developed only when statistical clarity, structural coherence, and a defined risk-reward profile are present simultaneously. Disclaimer. This content is provided solely for informational and educational purposes and does not constitute investment advice, individual recommendations, or assurances of future developments. Digital assets are volatile. Past performance is not a reliable indicator of future results. Quantum data analytics assumes no liability for actions derived from this information. Quantum data analytics. Analytical. Strategic. Innovative.